Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. I want to talk about the valuation for GameStop's collectibles business in this video. So as a retailer, they sell hardware, they sell software, they sell collectibles. I want to talk about worst case, base case, best case scenario as far as how someone would go about valuing specifically their collectibles line in this video. And I think you're going to get something out of it. If you do, would appreciate a like or a subscription on the channel. Also want to say thank you to those who join the channel as fans and friends. I appreciate all the views, all the work that you guys are doing. And congratulations, honestly, for educating yourself and making yourself better as an analyst and investor. So when you talk about the worst case for GameStop's collectibles business, you have to consider the fact that they're investing a lot in their collectibles business. Like the worst case is really still a case of growth when you consider the fact that the past couple quarters in Q4 of 2024, their collectibles business grew 13.5%. And then in Q1, year over year. Then in Q1, 55% year over year. Then in Q2, 63% year over year. And in Q3, we have Power Packs, which is not reflected in these past numbers. They just started their Power Packs business in Q3, and they just started selling Lego in Q3. And they're grading services with PSA. As PSA continues to grow, GameStop's partnership will continue to grow. The offerings of Power Packs will continue to grow. Right now, right now, it won't even let me look at it. Okay, there you go. Right now, their Power Packs are just selling Pokemon and football. And so, obviously, this is something that will grow, this will expand. Even the biggest bear in the world would have to acknowledge that whatever revenue GameStop's doing within these lines, they're going to do more in coming quarters because they just started these and there's so much obvious room for expansion still to come. Even their PSA grading service, Q4 was the first quarter that existed. So obvious, no one that's being truthful about analysis on business would make the argument that in the first quarter of a new business line existing, that GameStop has already fully saturated that business line. They just started this grading service partnership with PSA. And so, of course, there is still some growth left to come, even in the worst case scenario. Even if you don't think that the collectibles market will continue to grow astronomically, even if you don't think that graded cars are going to take over the world, even if you don't think that PSA is going to maintain its monopoly status as a grader, maybe other grading companies kind of begin to take more and more market share. Even if you don't think GameStop will continue to be the only physical retailer where someone can go, the only national physical retailer that someone can go sell their graded cards to and get their cards graded through, even if you think other retailers will also form similar partnerships, still you have to project growth in this specific portion of GameStop's business. Whether you believe in the biggest bull case scenario is irrelevant, and whether you think physical software video games have a future or not is irrelevant. This is a new business that GameStop's just entering, so get out of your mind the legacy GameStop retailer that you assume is doomed, because we have to value this collectibles business within GameStop, the retailer. So the floor scenario, the worst case scenario, basically you start with, let's say, $1 billion. This is kind of like your forward 1 year revenue projection. What do you kind of consider the base point, the easy to assess point for the collectibles business? I'm saying worst case, it's $1 billion. So if you look at what they've done so far, in Q1, they did 211 million. In Q2, they did 227. They're on pace to do maybe as much as 300 in Q3. And obviously, Q4 historically is 40% of GameStop sales. So if they're already at, what is this, 440 plus another 270 puts you at 710. They are already on pace to do more than $1 billion in revenue in collectibles just this year, not even projecting forward, the rolling impact of Power Pack's growth, etc. So kind of a $1 billion base scenario is really the worst realistic starting point. The margins on that, the worst realistic margins you could project is a 35% margin. So we know in 2018, so in April of 2019, they reported their 2018 numbers that their collectibles division had a 33% gross profit margin associated with it. And if you look at GameStop as a whole, back in 2018, their total gross margin was 27%. And we know that their gross margins year over year, while dipping as they shrunk, have grown to now 29% plus, 34% in Q1, obviously lower in Q2 because the Switch 2 came out. And as you can see, the margins on new hardware, new consoles is 8.5%. So that weighs on the total number. But we know that their total margins as a company have been improving. So we can assume that that carries through with their collectibles as well. 35 is really probably lower. In a recent video, I checked out their margins on their card marketplace, and it's really 40% plus more likely is the margins that they're getting on this part of their collectibles business. So all that to say, and Power Packs probably is even higher because they're probably just receiving basically a pure profit commission from PSA to be someone to sell on consignment, basically on PSA's behalf. So regardless, a 35% margin is really kind of the worst case scenario. Basically saying, let's just assume that they're doing the same thing that they've always done and bake in the improvements that they've already made on their gross margin. And let's just assume it doesn't get any better than that, even though obviously they're continuing to sell more collectibles. And then you talk about the growth. So the growth, again, this figure, that growth number, does not come into play with what's the actual valuation, but it's a key variable that to me is determining what type of PE do you give the collectibles business. So I'm saying 25% growth, worst case scenario, which is basically saying that they are not going to keep growing this fast, right? You're basically saying they're going to grow less than 60% slower than what they're currently growing at. So you're pricing into the collectibles business that graded cards happen to hit a little bit of a spike in the summer of 2025, and it's going to slow down. It's not going to evaporate. Okay, that wouldn't be a realistic worst case scenario, but it's going to slow down. The hype isn't going to continue on the same trajectory as it has done. You would still project growth because that's still generally a growing market. And of course, GameStop, like I said, is just beginning its personal entry into that market. And there's a lot of collectibles GameStop does not even sell yet, right? So if you take out, 35% of $1 billion is 350 million, and then you net out SG&A of 280, which that's based on the current year SG&A trajectory of around 800 million total. However, GameStop's continuing to lower this. So even in this worst case scenario, could SG&A end up being a even lower number that makes this 35% low margin on this 1 billion low revenue even higher than 70 million? Yes. Sorry if that was hard to understand. What kind of PE do you give a billion-dollar revenue company or business line with a 35% margin growing 25% year over year? Well, the S&P is growing at around 10 to 12% year over year income, net income, and their PE is 30. So you're taking a company that's growing twice as fast and has a higher profit margin, a higher gross margin than almost than a substantial amount of retail-oriented businesses have, and you're only giving it a slight premium to the S&P. If you take that 70 million, multiply it by 35, you get a worst case valuation for GameStop's collectibles business of $2.45 billion dollars. Now, what's the probability of this to me? I'd say it's 25%. 25% chance that basically the growth that GameStop wants to see in its collectibles business has already happened and it's not going to continue in a unique way. It's just like, here's a new line of the business, and it's more or less very predictable and relatively static. Now, if you add that together with their hardware and software worst case scenarios, you get GameStop, the retailer, worth a minimum of 3.4 billion in the worst case scenario, and a 23% chance that that's the case. Currently, GameStop, the retailer, is trading at a $1.2 billion market cap. Essentially, you net out the valuation for GameStop, the asset manager, which is substantially driven by their cash, their book value, and how do you value GameStop's management team, leadership team, in basically how you value cash in their hand. If you assume that you only value cash at 1 to 1, which again is the worst case type of valuation you could give that line, then you're saying generously GameStop, the retailer, is currently being valued at 1.2 billion, and we are saying worst case scenario that in reality they are worth more like 3.3 billion. So there's another 2 billion plus of floor market cap that you could expect GameStop to command, to deserve. And right now, you would say, wow, that company seems quite undervalued. Now, let's talk about the base case scenario, the fair scenario for the collectibles business. Basically, we're taking that 1 billion and we're making it 1.5. We're taking those 35% margins and making them 45%. And we're taking that 25% growth and making it 40% growth. I would give this actually a 50% chance of happening. If you want to get a little bit more shrewd, we could say 40% margins instead of 45. But that 1.5 billion in annual revenue, I would say is quite plausible that within 1 year, like if you were to take Q3, Q4 of 2025 and Q1, Q2 of 2026, I think this is a very reasonable projection. And it's related to the fast growth, not just of the collectibles industry as a whole, but also of GameStop's market share of that industry. Even if the collectibles industry remains static, if GameStop is increasing its market share of that industry, GameStop's collectibles business is going to grow. And what is getting in the way of GameStop commanding a larger market share of the collectibles industry? Basically, nothing. There is no national retail experience for the collectibles industry. There's a lot of online and there's not a lot of physical. And so there's a huge opportunity for GameStop to command market share and to operate their business in a way that's much smoother and much more enjoyable for a customer than your local card shop or certainly your local card shows where people are showing up into booths and may or may not be getting screwed by random people and having to navigate crowds to do these meet and greets to try to get this card and look up the worth of the card. I mean, huge. The fact that those are popular just shows you how much market share there is for the taking, how much demand there is for this industry. And so again, you net out that SG&A. Let's recalculate this since I decided to lower that margin on a base case scenario. That 1.5 billion times 40 is 600 million. You net out that 280 of SG&A and you get 320 in net profit annually. 320 million times a 45 PE would get you a $14.4 billion company. Oh, don't do the apostrophe there. We want to see it. Boom. $14 billion collectibles business. It really just comes down to, again, do they make a little bit more? Are the margins a little bit higher? And then do you give them a higher PE? So right now, again, a 45 PE is, I'm discounting the potential, even in this base case scenario, I'm discounting the potential that GameStop is entering into growth that is not necessarily indefinitely scalable forever. So when something's growing at 40%, if it's going to grow at 40% every year for a century, then this would be 100 plus PE, right? This would be off the charts PE in terms of how do you value this company. But when you're growing, partially because you're entering into a new market that is growing, but might not be growing as fast as you're growing, and then when you're growing in a market that some people speculate is a bubble, right? Some people think the alternatives, the collectible space is going to come back down to earth. Well, then, okay, you might grow 40% for the next 5 years, but then you're going to grow at 10%, right? So I'm not giving a huge PE to what would be huge margins and huge growth because I'm pricing in that it's not going to grow that fast forever, right? So let's give it a premium for now while you're on the early side of that growth. But if we were to do this again in a year or two or three, which we will continually throughout the years, which is why you got to give this video a like and a subscribe, okay? But when you do this 5 years from now, well, this number is going to be 15 billion instead of 1.5 billion, right? I'm not saying that verbatim, but you math it out, right? You grow 40%. What you want to see what it is? Let's just see. 1.5 in a year is 2.1, in 2 years is 2.9, in 3 years is 4.1, then 5.7, then 8.0. So okay. So then you're looking at an $8 billion company 5 years from now that's growing at a 20% rate. And margins are probably just as high, maybe even a little bit higher. But you take that 20% growth and you say, okay, well, that's 20% is, or even if you just say a 10%, right? Let's say it just grows in line with the S&P. It's fully saturated in um, in 5 years, which I think is, probably being too conservative. But even if it was, if their SG&A continues to come down, well, on that 8 billion, if they're still commanding that whatever 40% market share, that's still 3 billion of um, net income from this business 5 years from now, right? You tracking with me so far? And then what do you take out of SG&A? Well, let's just say it's still at that 280. Then you're still at basically a 3 billion flat, right? You go 3.22 to a 2.95. And then what at that point do you give it a 30 PE, right? You just put it in line with the S&P because now you're just growing at 10% instead of growing at 40%. Well, you take that and that's a $30 billion company at a oh, it's more than that. It's a 3 billion times 30. Oh, great. Yeah, that's an $88 billion company. Oh, geez. All that to say, even if you don't think this growth is going to continue forever, when you know the growth is coming for a while and the margins will continue and the top line will continue to grow at some level, then even if this growth rate comes down and this PE comes down, the future valuation is still going to command an even higher dollar figure, which would make you be willing to pay a higher PE in the short run to be a part of that long tail cash cow. So 14 billion for a company that once it's priced at just a 30 PE, 5 years from now is going to be 80 billion, right? This is present value. This isn't what it could be worth one day. This is how would you value the collectibles business right now? And under modest assumptions, you would say this is a $14 billion business. You add in the modest assumptions from their hardware and software, and you get a retail business that modestly is worth a $20 billion valuation. Crazy, right? Crazy. So a 20x basically from where it's currently trading as a retail business. And then you add in the asset management business. We'll save that for a future video. Bull case scenario, the fly scenario. You take that 1.5 billion, you make it 2 billion. How does that happen? Basically, if Power Packs goes off, we have no clue how much money this is going to make. But if the collectibles market, whether it's from their personal store marketplace and or from Power Packs, if collectibles continues to grow at a super high clip, then their collectibles income is going to be a lot higher, right? If they are growing at 63% after growing at 55%, after growing at 13%, who's to say in Q3 they won't grow at 75%, right? They are not only growing, but they are growing increasingly quickly. So how do you put a ceiling on what that can earn? You just can't. And so you take that 2 billion in annual revenue, and let's take that margin down again. Let's say they get this up to a 50% margin, which some of y'all will think that is insane. Whether or not they can achieve a 50% margin really comes down to how do they account for this Power Packs business and what type of revenue does this Power Packs business do? Because this Power Packs business might very well be 60% plus margin. Let's say it's a 50% margin, so they're making $1 billion. Then you net out that 280 and you've got 720 in annual revenue, and you give it a 55 PE, and all of a sudden this is a $39 billion business. Nope, not that much. $39 billion business. So again, it comes down to what's the growth rate. And basically I'm saying they're going to keep growing how they've been growing. Keep growing how they've been growing. And you give them a PE that says, hey, it's going to come down eventually, but not anytime soon. And you get a $40 billion collectibles business. If you take the weighted probability of all three of these business cases, you would say fair value for their collectibles business is 17 billion. Their best case as a retailer, if you add in best case for software, best case for hardware, in terms of how you would value it today, not what it's going to be worth one day, how you'd value it right now, you'd say they could be worth as much as $60 billion. And if you want to weight it by probability, you'd say fair value, they're a $25 billion retailer, plus however you value them as an asset manager. Makes sense? Let me know what you think in the comments. Would love to hear your thoughts as well. That's all I got for you in this one. But I will see you in the next one.